I just read that Tesla was the most bought stock over last few weeks, even in large platforms like Hargreaves Lansdown. So, if you love Tesla, you are not the only one. A lot of us adore holding stocks like Tesla and also look up to great investors like Warren Buffett and share his wisdom. But these two are rather contradictory. It is almost considered a sin by hardcore Buffett follower to hold stocks like Tesla. Berkshire Hathaway never held any position in Tesla and openly mentioned that they never will. Well, welcome to the most enduring battle between value versus growth investing. Hey guys, and welcome back. Before we get started, can I please remind you to hit that beautiful like button and subscribe to this channel if you haven't done so already. Okay, so there are two completely opposing school of thoughts when it comes to fundamental approach to investing. There are followers of value investing and followers of growth investing. And might I add that they don't generally get along with each other. So who are these followers? In a nutshell, growth followers believe that you are more likely to grow your money if you invest in companies that are also growing themselves through their revenue. But value investors believe that it is rather hard to make a good prediction about how well a company is likely to grow in the future. And if the company is already growing quite well, it is less likely to be able to repeat that amount of great growth performance year on year. So you're better off investing in companies that are currently unloved in the market, but are great, stable companies that allows you to make good and plausible financial predictions about its future. Both kind of make sense to me, I think. How about you? How would you describe your own investing style if you had one? I would love to know about that, so do comment it below at some point. Right, back to the story. So what is this battle all about? Well, generally speaking, and also seen from my own experience, value investors tend to look down at growth investors, since growth investors actually pay a lot higher for a company than it's currently worth. What do I mean? Basically, growth investors buy stocks that have a very high valuation ratios like PE and PB numbers. While it's true that they do that, what growth investors would actually tell you is that they're making a great choice by investing in this company early on. They are happy to pay a high price now because the company is actually likely to grow a lot in the future. And so you're better off entering early to be able to reap the full reward when the company does reach its full potential. Contrast to them, value investors, they are not quite ready to take on that leap of faith. They don't want to invest in companies that they don't understand very well or don't know where it's going. So they would much rather stick to companies that they know and they understand. These investors are all about finding the true intrinsic value of a company and paying less against it. And as such, believes that they are making a clever and rational decisions. At this point, I must introduce you to the father of value investing, Benjamin Graham. His theory goes that irrational investors actually end up overpaying for a stock with the false hope of supercharged future return, which may or may not actually happen. And as a rational investor, you should never ever pay any more than the true intrinsic value of a company. Basically a chart like this. You have the life of the company on the x-axis and value on the y. Generally, if it's a good company, it should have its intrinsic value growing over time, like this straight line here. However, while the intrinsic value is this straight line, note that it is not the traded value of the company, i.e. the stock price that we actually pay to buy and sell. As you all know, the stock prices are by nature quite volatile and at times can go above or below the straight line. So, as a good rational value investor, you should only be buying shares when the share price falls somewhat below this line with a margin of safety. Makes so much sense, right? Although Benjamin Graham was the pioneer of value investing, it was really Warren Buffett who made this investing style popular and brought it to the masses. Buffett sees the intrinsic value of a company as all the cash that you're actually able to extract out of the business during its remaining life. So this formula here. You calculate the intrinsic value, or the straight line, by adding the company's future book value plus all its future dividends. And then you discount it back to today's term so that you can compare it to the current market price and come to a decision of whether the company is overvalued or undervalued. And as you can already guess, it is only possible to make a plausible forecast of the company's intrinsic value if we are able to study the company's past and estimate its growth rate. And therefore, stability in earnings growth and dividend is everything when it comes to value investing. By the way, Benjamin Graham's book, The Intelligent Investor, is the most recommended reading for anyone who wants to learn about investing. I'll have it linked below. Right, so what are the key characteristics when it comes to value and growth stocks? Starting with valuations figure. As I've mentioned already and you already know, growth stocks tend to have a very high valuation ratio, so very high PE and PB metrics compared to value stocks. And when it comes to dividends, growth stocks tend to have very low dividend yield, and sometimes they don't pay out any dividend at all because firstly, they can't afford to pay out their shareholder because they're still new or growing company. And secondly, because it makes more sense for them to reinvest their earnings back into the company so that it can grow faster rather than paying out a dividend. Next are the growth metrics. As you can already intuitively guess, growth stocks are going to have a very high growth metric. So growth in EPS, earning per share, DPS, dividend per share, sales, revenues, and everything else. While the value stocks, it's not necessarily true that they will have negative growth. What you're more likely to see is that they will have a low level of growth, and those growth numbers is gonna be quite stable over time. Next is the price volatility. It's good to note that growth stocks tend to have a higher price volatility compared to value stocks. And that's because they are more reactive to market news and anything negative that may affect their earnings. Compared to them, value stocks are less volatile because they are more stable and more predictable as a business, so they react less to external events and news. I like visuals, so here's a really good visual of where growth and value companies generally sit in a company's life cycle. Notice how every company at some point is expected to decline and die, which is of course no one, even the value investors, would want to buy, regardless of how cheap that company is. So a lot of value investors would also look for companies that they know will stay relevant and find ways to keep growing. Hence the extension line in the chart. So the million-dollar question is, which investment style is actually better? All the value investors will tell you that value will ultimately outperform the market and growth over time. And that's because it's the most logical and rational way of investing. And they will also tell you that in value investing, you will have to go through a long period of time when the investment style doesn't work. But it is almost a precondition for value to actually work, if that makes sense at all. But it has been just way too long since value last worked. So the real question is, how long is actually the long term? I don't know the answer to that. I don't think anyone knows. Whoever I've spoken to or whatever papers I've read, everyone is asking the same question. Is value dead? Again, I don't know. I don't know a lot of things. But according to studies and research, every business cycle accommodates for both style of investing. By business cycle, I'm referring to the economic cycle of growth and recession. Note that business cycle is expected to last for about 10 years. In other words, recessions are expected to come every 10 years. And what the study says is that growth investing tend to outperform and to do better during the middle of the cycle. Basically the time when the economy is quite comfortable, consumers are happy to spend, and businesses are happy to invest and to grow. Contrary to that, value investing tends to work better during the too extreme or the turning point in the business cycle. So as we are approaching recession and when the economy starts to recover. And that's driven by the economy and the financial condition of the country. Observing business cycles are actually practical ways for investment companies to maintain their asset allocation and advise their clients. By observing where we are actually headed in the business cycle, we should be able to tilt our portfolio to be more growth or more value. Before we give example of value and growth stock, I wanted to clarify one myth that people tend to hold about it. It is the fact that all technology companies are growth stocks, while staples and consumer goods sector or companies are all value stocks. That's not true. Every sector has some element of value and growth in them. For example, if you take Cisco as a company, it is a technology company, but don't be surprised to see this company being held by value and income investors. Examples: companies like AT&T, Disney, Coca-Cola, BP, Royal Dutch Shell, British American Tobacco, they are all examples of value stocks. And companies like Facebook, Tesla, Alibaba, Tencent, Nvidia, they are all examples of growth stocks. And come to think of it, most of them are actually tech companies. I haven't come up with a great diverse range of growth stocks. Anyway, okay guys, back to this battle between value versus growth. What are your thoughts? The market is still scratching its head thinking why value investing hasn't worked for so long, because it's just so rational, right? It makes sense. The fact that you have this true intrinsic value of a company, while the company's share price go up and down against this intrinsic value, and if you're able to buy when the share price is below the intrinsic value, you're likely to outperform and do better. It's quite logical, yet it hasn't worked for so long. So what's going on? It still remains quite a mystery. So I have my own view. One of my view is that value investing hasn't worked because of interest rate. It's been so low for so long. And secondly, because of our greed. We're just greedy and we just like buying companies that are growing and giving us a huge amount of return, even if it doesn't bear any resemblance to the underlying valuation of the company. So maybe we're all just turned very irrational, and irrationality kind of rules now. Anyway, that's a topic on its own, and I'm getting pretty philosophical here. So it's a sign that I should go. But before you leave though, don't forget to comment about how you would describe your own investing style. Be creative with that. Take care.